Hello. Today, I want to introduce you all to a powerful investment strategy that's quickly gaining traction called direct indexing. Now, most of you are probably familiar with traditional index funds, which aim to mirror the performance of a specific market index, like the S&P 500, which you can see with this example here with the fund SPY. When you invest in an index fund, you're essentially buying small portions of the companies within that index. However, with direct indexing, instead of purchasing a single fund that holds all of the stocks in an index, you're buying the individual stock that makes up that index directly. For example, if you look at the fund SPY, rather than holding fractions of Apple stock within the fund, you would purchase Apple stock directly within your portfolio should you implement a direct indexing strategy. Now, while this approach does require more capital up front and might not be suitable for everyone, it's an excellent strategy for higher net worth investors and has become increasingly more accessible as of late. With direct indexing, you not only maintain a diversified portfolio, but you also gain control over what you own. This control allows you to customize your portfolio according to your preferences. You can align your holdings with your values, or you can implement a tax strategy that's tailored to your specific situation. For example, if you want your investments to focus on companies with a positive environmental impact, you can screen your holdings to exclude those with poor environmental scores. However, one of the most significant advantages of direct indexing is its potential for tax savings. Because you control the individual stocks within your portfolio, you can implement strategies like tax loss harvesting, for example, where you sell positions at a loss to offset gains elsewhere in your portfolio, significantly reducing your overall tax burden. Let's take a simple example of Coca-Cola versus Pepsi. Let's say you buy $100 of Coca-Cola and you end up selling it at a loss of $10. You then use those proceeds to purchase an equivalent amount of Pepsi shares, and then you can use those $10 in losses to offset gains from the shares of Pepsi out into the future indefinitely. Now, if we compound that and look at an example where, say, investment A is company stock and you have $20,000 worth of capital gains, you could essentially pay $7,000 worth of taxes on those gains, assuming a 35% tax rate and a short-term capital gain. However, if you implemented a direct indexing strategy with your investment B, you could harvest up to $25,000 in capital losses in this example and offset those $20,000 in gains dollar for dollar. You can also use an additional $3,000 of those losses to offset your income dollar for dollar, and then the remaining $2,000 in losses you can carry forward indefinitely to offset gains into the future. This can result in significant tax savings, and in this example specifically, $8,050 in tax saving. So to recap, direct indexing offers control, allowing you to own the individual stocks in an index directly, personalization, allowing you to align your portfolio with your values and your preferences, and ultimately tax efficiency through strategies like tax loss harvesting, which can significantly reduce your overall tax burden. If you're interested in learning a little bit more about how direct indexing fit into your financial plan, please feel free to reach out. We're happy to discuss how this strategy might benefit you and take your investing to the next level. Thank you for watching and have a great day.